So you have basically clicked this video because you want to learn how to trade against the retail traders. You are in the right place. But there are a few things that I need to point out before we talk about anything else pertaining this particular strategy. A lot of retail traders are scalpers, and for you to be able to trade against them, you need to be some sort of a swing. A swing trader will be able to hold trades at least for more than 2 or 3 days. Then the other thing that you need to take into consideration is a lot of retail traders overtrade. And for you not to be like them, you do not need to overtrade. However, you need a particular trading strategy for you to be able to do so. So we are going to define this strategy from basic principles so that you will be able to apply this on your own trading style. I'm going to remove all the indicators so that the charts may be clear because we are not going to be needing any one of them. Before we continue any further, please make sure you check out the notification bell icon so that you will be notified each and every time we upload a new video, as well as every time we go live. On that note, let's jump right into the information. The first thing that you need to do is to be using higher time frames, the H4 time frame. The H4 time frame is basically a time frame that shows you a period equivalent to a week if you are or if you have put this period separators. In this case, we can see the start and end of a week. So what we need to see is basically a week of consolidation for us to make our trading decisions. How do we define a week of consolidation? Someone may think that a week of consolidation only involves a phase whereby there was no trend. That is true, but a week of consolidation might be or might look like this, whereby there is an up, a down, or what we call a whipsaw in short. So in this particular week of consolidation, we consider the opening price of the week and the closing price of that week. If those prices are almost equivalent, they might not be as exact to the dot, but they are almost equivalent. We call that week a week of consolidation. So the first job that you are going to attain when you want to trade against retail traders is to be able to locate weeks of consolidation over several number of pairs. We are not going to dwell on only one pair because this will reduce our frequency of entries. So we are going to have maybe 10, 15 pairs that we'll be monitoring so that we get these particular weeks of consolidation, opening and closing almost equal. So after that, we need to see the new week issuing what we call a fake move or an induction move. So as you can see, this particular week, I'm going to box it so that we can see clearly. This was a week of consolidation because the opening and closing prices were almost similar. So in this particular week, the following week was this one. On this week, we want to see the fake move or the induction move. On the fake move, we can see this move going outside this range to the downside, and we consider this the fake move. After that, we now start to look for candlestick reversal patterns below the low of the previous week. We can see this one being a very beautiful engulfing pattern that was issued. This one was a beautiful engulfing pattern that was issued, and that is where we were going to make our entry. Retail traders were now looking to keep on dumping to the downside because of the set trend. So to trade against them, you are actually reversing against what they are thinking. So let's now have much more examples so that we can fully comprehend and be able to understand this particular strategy. So in this particular case, we can as well see that this particular week in subject, although it was a good week to our trades, we can see that there was a good entry below last week's low. It also ended as a week of consolidation. We can see the opening price and the closing price of this particular week was also almost similar. So we've said when this happens, we now expect to see a fake move against the head, right? So this was a week of consolidation that I've boxed again because the opening and the closing price. fake move was issued, which is the initial move that is issued as the week begins. The initial move that was issued was this one, and the market went to the upside, or the upper part of this particular week. Retail traders were induced to go to the upside, but later we can see there was a railroad track on the H4 time frame that was issued, which was our point of market entry of last week's high, and the market went to the downside. This was not a week of consolidation. As you can see, the opening and the closing price were different, meaning it was a week of drop, right? Looking or going forward, we can see this was also another week of consolidation. Opening price almost equal to the closing price. And after that, let me box it. So you will be actually boxing a lot of pairs so that you will be waiting for the fake moves that will be issued. A fake move was issued to the downside, and then this engulfing pattern was issued. It's unfortunate that this week could have taken out your stop loss because it was big, but we can as well make a re-entry because an engulfing pattern was issued and the market went to the upside like that until we wait and get a week of consolidation. We've said we need to get a week of consolidation. We can see the opening and closing price of this week was also almost the same price. So it was a week of consolidation. Let us box it and look for the entry on the following week. We can see that after boxing this particular week, we had this fake move to the upside and this 3 candle pattern, or basically someone would say he wanted to see this as an engulfing pattern. But if there is a big candle like this, we need to at least wait and get an entry at 50% or at pullback of 50% of our candle. So our entry was going to be at this particular point, because making an entry at this candle closure was was going to make our stop loss too wide. So we need to wait for a pullback. Usually after this happens, the market will pull back to 50% of that spike candle. So this is where we were going to make our entry, and we can see the market went our way like that. So basically you will be looking for the first or the initial move to the week of the week to the low or high of the previous week, so that you can get an entry against the head. And the head would have been induced to go in that particular direction, but you will be waiting up until the minute when you see a proper entry. So basically that is what we had for today. On that note, we've come to the end of our today's video. Thank you for watching. Like and subscribe, and I'll see you in the next one.